Markets look calm on the screen tonight, but calm doesn't always mean safe. We've got grains marking time, cattle sending mixed signals, and crude oil trying to firm up again. The kind of setup that can quietly tighten margins before anyone feels it. The question for tomorrow morning is simple. Are these just routine midweek moves, or the early stages of a squeeze that catches unprepared operations off guard? Over the next few minutes, we'll walk through where the trade is leaning, what's driving the tone, and which pressure points deserve a closer look before you lock in any plans. Good morning. This is Boots and Bushels, your daily look at the markets that move your farm and ranch. We're getting you set for Thursday's trade, using where markets were trading near late in Wednesday's session as our risk map. The goal is not to tell you what to do, but to make sure you know where the pressure is building and where it might show up next in your cash flow. Today's risk map centers on three big themes. Quiet but fragile grain markets, cattle trying to sort out direction, and crude oil testing how much fuel costs might push back on margins. Let's start on the grain side of the ledger. Corn futures were trading near 436 and a quarter on a nearby contract late in the session, holding a modest upwards bias compared with recent trade. The market tone feels more like cautious grind than breakout, with buyers stepping in just enough to defend the lower end of the range. The pressure point here is whether end user demand and export interest are strong enough to keep that floor under the market if outside money turns cautious. What traders are watching next is any shift in basis in export sales that might hint at either stronger pull from feeders and ethanol or a slowdown that leaves futures looking a little too tall for comfort. Soybean futures were trading near 1147 and 3/4, with the board shading a bit lower into the late trade. That kind of slip suggests the market is still nervous about big crop expectations and stiff global competition. Even as crushers and exporters keep a steady bid underneath, the risk here is that if South American supply ideas stay heavy, rallies can get sold quickly, leaving producers staring at a board that won't quite reward patience. What this could change in your operation is timing. Any pop driven by weather scares of logistical hiccups may need a closer look, because the second layer concern is whether those pops last long enough to be useful. Chicago soft red winter wheat was trading near 436 and a half on the nearby, showing a small uptick but nothing that screams breakout. The market feels stuck between global supply that still looks comfortable and ongoing worries about weather, war risk, and export competition that can flare up without much warning. The pressure point is whether fund traders stay short and comfortable, or if any fresh weather or geopolitical headlines forces them to cover in a hurry. Producers are watching for signals that basis or export demand might tighten up supplies enough to spark a stronger bid, because until that shows up, wheat looks like it's trading in a prove-it zone. Cattle futures were trading near $242.50, a touch softer into the late session. That kind of ease suggests the board is still trying to balance strong underlying beef demand with concerns about consumer resistance and heavier cost up and down the chain. The risk here is margin pressure. If cattle prices hesitate while feed and fuel stay firm, it squeezes both feeders and packers in different ways. What traders are watching is whether cash trade later in the week can steady the tone, or if packers successfully push bids lower, signaling a little more leverage shifting away from the country. Feeder cattle futures were trading near $364 with a firmer tone late in the day. That strength hints that the market still believes in long-term demand for feeder cattle, even as input costs and pasture conditions raise questions. The pressure point is the cost side of the ledger. Higher feeders tied to the steady to firm feed and fuel can make break-even feel pretty unforgiving. What this could change on your farm is the comfort level with adding weight or bringing in more numbers. The second layer issue is whether the future board is building in more optimism about down the road fat cattle prices than the cash market is ready to confirm. Lean hog futures were trading near 92 and a half with a modestly firm bias late in the session. That suggests the market sees some support from product demand and seasonal expectations, but it's not a runaway rally by any means. The risk here is volatility around wholesale pork values and export flows. When those wobble, hog futures can reprice quickly. What traders are watching is whether packer margins stay healthy enough to keep chains moving without pushing too hard on cash hog bids, because the balance has a direct consequence for farrowing and finishing plans over the next few months. Crude oil futures were trading near 64.90 late in the session, a solid move higher on the day. That firmer tone underscores how sensitive energy markets remain in global supply headlines, shipping routes, and broader economic worries. The pressure point for producers is straightforward. Higher fuel costs bleed directly into every acre worked and every mile hauled. What this could change next is your cost structure heading into spring work. If crude keeps pressing higher, the market may start forcing tougher decisions on timing of field operations, delivery schedules, and how aggressively you choose distant acres. Weather across key U.S. production areas remain a quiet but critical player in this whole setup. In many regions, producers are watching soil moisture, temperature swings, and any hint of pattern shift that could reshape planting windows or pasture recovery. The consequence of even a modest change, a drier than expected stretch or a colder snap, is that markets like corn, beans, and feeders can react faster than the physical countryside can adjust. What traders are watching is not just today's forecast, but the trend. If the pattern starts leaning clearly wetter or drier into spring, that becomes the next excuse for the funds to either defend support or press resistance. And that ripple shows up directly in your pricing conversations. In ag news, one key storyline right now is the ongoing tug-of-war in global grain exports. Buyers continue to shop around for the best combination of price, freight, and reliability, which keeps U.S. offers under constant comparison with South America and the Black Sea. The pressure point is whether U.S. origin can stay competitive enough to keep corn, beans, and wheat moving at a pace that justifies current future levels. What to watch next is the flow of weekly export reports and any fresh headlines on shipping routes or port logistics that might shift demand back toward or away from U.S. supplies. Another major story is how input suppliers are signaling their expectations for spring demand, from seed and chemical pricing to fertilizer availability and fuel surcharges. The tone feels like it's leaning toward steady to firm rather than cheap and easy. The risk here is a margin squeeze where futures don't move enough to offset higher input costs, leveling budgets tight even in a decent yield year. Producers should keep an eye on updated cost sheets and supplier notices, because any surprise fee or surcharge can quickly change what looks like a workable plan into a stretch. On the livestock side, there's an ongoing focus on packer and processor margins in both beef and pork. Plants are constantly adjusting line speeds and bids based on product demand, labor, and byproduct values. And that has a direct impact on what they're willing to pay in the country. The pressure point is whether packers feel comfortable enough to pull cash bids lower, or if they need to hold or raise prices to secure supplies, especially for higher value cuts. What markets are watching is any shift in negotiated trade volume and carcass weights that might hint at leverage swinging one way or the other. There are also policy and regulatory developments on the radar that could reshape planning over the next year or two. Agencies continue to review rules tied to conservation, environmental standards, and livestock handling, and any adjustment there can ripple through compliance costs and paperwork. The risk here is not political, it's operational, in the form of new requirements that demand time, money, or both. What to watch next is official releases and farm-focused briefings that explain what has actually changed, so you can separate real obligations from the rumor mill without the noise. And finally, there's a steady drumbeat of technology and efficiency news, from new hybrids and genetics to on-farm data tools and automation. These developments promise better use of inputs, more precise applications, and tighter control of costs. They also come with upfront price tags and learning curves. The consequence is a widening gap between operations that can adopt tools efficiently and those that feel locked out by cost or complexity. What markets are watching is how quickly producers take up these tools, because adoption rates can quietly shift yield potential, cost structures, and even basis over time. As we look ahead to Thursday's trade, the big picture is a set of markets that look calm on the surface but carry real, if quiet, risk underneath. Grains are trading near familiar levels. Cattle are pulling in different directions. Hogs are trying to hold a firmer tone, and crude oil is nudging fuel costs higher just as spring work creeps closer. None of that guarantees a breakdown or a breakout, but it does mean the margin space between your cost and your revenue can narrow faster than it feels like from one day's board action. For producers, the key is staying aware of where the pressure points are instead of chasing every tick. Watch how demand, input costs, and weather trends line up over the next few weeks, because that combination will likely matter more than any single headline. Thanks for spending part of your morning with Boots and Bushels. I'll be back here tomorrow with more of the information that helps producers make critical decisions.